Again, my name is Matthew Kulig. I'm the president of the Missouri Venture Forum. Missouri Venture Forum started in 1984, 1985. We are a membership organization, and we have been supporting, we are the longest supporting entrepreneurship organization in the state of Missouri. We do educational programs like this throughout the year. We have 10 breakfasts where you can hear from speakers such as the people you see up here. They'll talk about what's going on in the St. Louis ecosystem. We also give companies an opportunity, new companies, in a program called 2-Minute Forum to present their elevator pitch to a live audience, and also have a table where they can talk to people about their needs as a startup company. It's a very unique public forum that is based here in St. Louis. If you're not a member, I invite you to join. It allows you to network, it allows you to participate in the educational programs. More importantly, it allows you to volunteer and give back to the community. We are a volunteer-based organization doing what we do. So all the work that you're seeing here today, all these panels, were all put together by volunteers. And we're very proud of this event. This is our flagship event, and we look to continue it for years into the future. So it is unique because it gives the public a opportunity to attend for free panels about how do you start companies from your idea all the way to exiting a company, and you're hearing from experts. So this year, last year we wrapped up with a speaker. This year we decided we would take a little bit of a turn, and we're going to do a town hall meeting. And so what I have up here is a variety of people who actually write checks for ideas. And so it's going to be a very interesting panel and town hall meeting, and it's really just going to be kind of open-ended. We're going to, have them talk about their focus and who they are, and what kind of investments they make, and then we'll ask a variety of questions, and we'll open it up to the audience for questions as well. So I'm going to start with introductions. Elise, if you'll go first, and we'll just move down the panel. Talk about who you are, but also what type of investments you make, and then hand off to the next person.
Well, good evening, everyone. My name is Elise Miller-Hoffman, and I'm here representing Cultivation Capital. At Cultivation, I manage our Life Sciences Funds 1 and 2. And for those of you that are entrepreneurs, something you always want to know before you walk into a pitch is a little bit about the fund thesis. So to tell you a bit about ours, we invest in life sciences companies. So this could be therapeutics, diagnostics, medical devices, a category called research tools and reagents, and also some healthcare software as well. And our sweet spot is coming in at the pre-A stage. So typically companies that receive investment from Cultivation have had significant seed investment, they've had traction. If they're a company that has revenue, they have some great revenue traction. But they're not quite ready to raise a big Series A round yet. They just need that little hump to get them to the big raise. So this is where we typically come in. A lot of times companies are raising $1 to $2 million, and we like to come in with an average check size of about $500,000. So our investments range anywhere from $250,000 to $1 million in an initial investment, and then we will leave money as well for follow-on funding for our top performing portfolio companies as well. So this is a bit about Cultivation Capital Life Sciences Fund 1 and 2.
Okay, Elise, thank you. I'm Brian Kinman. I am the chairman and CEO of the St. Louis Archangels. Many of you saw Bob Calcaterra sitting up here in the last session, who's one of our angels and a former president of our organization. The St. Louis Archangels, we keep our membership between about 70 and 80 active individual members. And we are an investor network. We are not a fund. So we are an organization that spends our time identifying deal opportunities that our members would like to see, helping them to successfully present their idea, their option, their business to our members, and then helping them with some tools and other support mechanisms to do due diligence and decide or not to invest in these particular companies. So in our history, Bob actually mentioned in the last one, we have, to date, we have 82 businesses that we've invested in. We're at about 75 million in terms of what's been invested over that time. Now don't do the division. We don't put $1 million checks in individual small startup companies. The companies come to us many times, usually in the seed stage, when their investment range is in the, their valuation range is in the $2.5 to roughly $4 million level. Very early seed stage, many times just about to hit revenue, maybe just starting to hit revenue and validate their idea in terms of where they're going. That's when we're there. That's when they have a hard time finding money elsewhere. That's why they call us angels. We come in at a time when others will not, and help get them going and move them to that next stage where they maybe work with a lease, if you're in the right industry, in terms of moving forward, and ultimately with some of the other venture funds as we go forward. But we're at that early stage. We also, and the reason we're at that 75 million is that once we're in, when you come back for the later seed or the A or the B round, we will also participate in those rounds. So that's why the dollars get up there. A dollar amount of investment ranges from, we had one last year, was one person, 25,000. We've had some that were, 500,000 in the very recent time frame. Industry, we're open to looking across the board. We're interested in companies that have a St. Louis connection, not necessarily in St. Louis. Coming through an accelerator in St. Louis is fine as we look at that, and then we hope to attract you to keep you in St. Louis going forward, but that's us. So I'll pass it to Ryan.
Great. I was on the last panel. Ryan Rakestraw, Monsanto Growth Ventures, corporate venture capital group, focusing on investing in agriculture. Some new information for those of you who stuck around. So we invest typically at the Series A level. Our median check size is around $4 million, although we've invested as low as $250,000 and as high as $7 million as an initial investment. And then we invest throughout these different stages of companies. So we'll follow on and typically look to have $10 to $15 million of exposure for each investment throughout that lifetime. In addition to the financial investment, we're looking for companies that there can be some other type of relationship that develops between our portfolio and Monsanto, which takes the form of some type of customer relationship, partnership, collaboration, or in some cases a future acquisition for the company.
I'm Brian Hopcraft, Managing Director of Lewis & Clark Ventures. We're a local venture fund here. We have $130 million. We are investing at the A and B stage as well. So, part of our thesis is we want companies that have traction, that have customers, that have revenue. We're interested in kind of three broad categories. So, ag tech is certainly one of them, and we've co-invested with Ryan and his fund. Healthcare and digital health, or digital healthcare IT is another big one for us. And then anything in kind of software as a service, technology is kind of that third bucket. I guess one of the tenets of our fund and theses is that we're going to be active investors. So we want to be we want to have a board seat. We want to lead the round, which typically means we'll set the price of the round, do the diligence, find partners if we need to syndicate, and if we're getting more money for the rounds. Our typical check size is pretty similar to Ryan's, so it's about $2 or $3 million on the low end, all the way up to maybe $7 million in that initial investment. Eric?
I'm Eric Golvey. I'm president of the Biogenerator. We're an early stage life science investors providing risk capital and then a host of other services to early stage startups in the region. We invest very broadly across life sciences, diagnostics, therapeutics, devices, ag, digital health. And then we also invest in companies that are fast to revenue, fast to product, and hire people more quickly than your typical venture-backed company that has a limited amount of employees they can hire so that they don't have too high a burn rate. So we invest in companies that provide services like contract research organizations, contract manufacturing organizations, companies that provide research tools. So we have a mix of companies that are traditional venture-backed companies that we back, and then we have other companies that are more job-focused. Some of those may also be venture-backable, but not all of them. We invest across a number of different stages. Essentially, if we take on a company, we realize we have to think about making a commitment from the first dollars in, as little as $50,000, all the way to the point where a company gets its true first institutional round, where there's a major VC participating in that round, and we have to be prepared to support those companies from first dollar in all the way through, which can be a pretty long time frame if you're starting with a $50,000 seed investment. So we can come in and invest multiple times. We invest at pre-seed, seed, and the bridge rounds that typically take a company from their seed investment all the way through to that institutional round. And we supplement the capital that we bring in with other programs that we have to offer, for example, to lower the cost of getting early stage life science companies off the ground. We have a lab facility in the Cortex district that we can offer to companies that's heavily equipped with capital equipment, that companies can have access to lab space and equipment. We have an entrepreneur in residence program to try to bring more talent to bear to help our portfolio companies. And we have pre-investment activities where we can we have coaching programs for first-time entrepreneurs, and we have pre-investment grant money we can offer, and we even have a program to help companies that are going after commercial grants as their first source of funding.
Thank you. Michael?
I'm Michael Keim. I'm with iSelect Fund. iSelect Fund is a venture capital fund too. We're syndicate capital, so we're not going to lead a deal. We've co-invested, I think, with everybody on this panel except for you, Ryan, and we're looking for that opportunity. So I think I've got a few ideas for us here. We've invested in 24 companies to date. We're a little different than most funds in that we're evergreen. We're not a closed fund, meaning we raise one set of capital and we invest that capital and we're done. We continue to raise capital. We continue and invest over time. Right now, we've got 24 companies in our portfolio. Over the course of the remainder of this year, we're going to deploy around $25 million in those investments and some new investments that we're looking at. And we're out actively looking for opportunities right now.
All right, great. Thank you very much. And that was a very broad swipe of different type of investors and investments. So I do need to encourage you to fill out the surveys on this panel. And then just to remind you that there is a free membership to MDF when this is all done. So I'm going to start with some questions to the panelists. And I lost them, hold on. All right, so the first one, having pitched to a lot of companies, I get asked all the time, you know, how do you pitch? And my question to the panel is, what should entrepreneurs not do during a pitch? So, Elise, go ahead. You can start with that one.
Sure. I guess one of the first things I would say is don't assume that your listener understands your business as well as you do. A lot of times, you know, I'm working with highly technical businesses and they're doing amazing scientific research, but we don't actually have to understand the ins and the outs of how the technology works in a first meeting. The big thing that we're trying to figure out is what is the value that your company brings. So what is the pain point that your customer is experiencing and how is your business going to address that pain point and then beat the other competitors in the market. So really, do not be afraid to explain it as if you're talking to a fifth grader. You can kind of work your way up in terms of technical difficulty based on, you know, the feedback that you get from that investor. But I would say start simple and make sure that by the end of that time with your investor that they can give your elevator pitch. And so usually that's really just explaining clearly and simply what your value proposition is.
There's so many, but I think I'll start with kind of an extreme position, and that is don't be a used car salesman. And I say that because so often we'll have people come and pitch to us and they'll be dodging and weaving in front of us as we ask questions because they are anticipating what we think we mean by that question, and they're almost negotiating against themselves in front of us. All we want to know at the pitch is who are you, what is your business, what is your idea, what have you done, where's it going, what could this be? We'll ask the other questions later in due diligence. We just need the pitch to come out. And when you start dodging and weaving and looking like you're trying to sell me a car, I'm not interested because don't forget, what you're really doing is you're trying to entice me to be your business partner. and as your business partner, I'm gonna be with you a long time. So if you fib to me in the pitch to make the sale, I'm gonna find out, and that's just not a good thing. Of course, we're not gonna let that happen anyway, but if I could give that advice, that would be the advice I would give on an extreme basis.
Right.
Yeah, maybe a couple of things. First, this is I think a mistake would be to view the pitch as the entire process. That this there's more than just the pitch, and in fact, making the pitch successful would have some pre-work, sending material out in advance, making sure that investors have an opportunity to ask questions and that type of thing. So take this, take the pitch as one point in the process. The other thing I would say is, realize that venture capital firms are looking at a lot of different opportunities. Our team consistently looks at over 400 investment opportunities per year. And so really have something that stands out, that isn't necessarily exaggerating, but have something that you think is especially unique, interesting, and compelling about your business. And do a good job, telling that. Don't be excessively modest, but don't be a used car salesman. But have that have that as a key point. Why is this interesting? And make sure that clearly gets across, and even the investor can say that at the end of the meeting.
Yeah, those are all great comments, and I can think of so many. A couple would be, don't forecast that you're going to be $1 billion company after 4 years.
How about $1 trillion?
Trillion? We're in at $1 trillion. But it really talks about having what's a realistic expectation of your company. So that's always interesting when you see that. I guess the elaboration of something mentioned earlier. Oftentimes we see pitch decks that have 100 slides and 80 of them are on the product and product detail. And I think the points made earlier is you can have all those in your appendices for questions, but maybe you only have 1 or 2 slides on your product. So at that first meeting, you're really just trying to get a sense of what it does. We'll come prepared, so we'll know a lot about it. But spending 45 minutes of that hour pitch on your product isn't going to get you anywhere. And then I think lead with don't be shy with the flaws in your company. So if you we're going to find those out through diligence, through meetings going forward. And I think the more you're upfront about those things, the more credibility you have. So if you don't have any financial information, expertise in your company, don't try to hide that. Say, yeah, eventually we're going to hire a controller, or a CFO's down the road, but we know that's not our strong point. So those things only you gain credibility versus trying to hide those. Eric?
Yeah, maybe adding a little bit to what Brian is saying is just be very self-aware about your company, what stage you really are in, and the strengths and weaknesses of your team. So, if you haven't raised any money before, don't come in and say, I need to raise $5 million, I need to close in 3 months. We see that a lot, people sort of thinking that it helps them to basically ask for far more money than they're actually ready to raise. Likewise with your team, don't be afraid to say, I don't know the answer to a question if you don't know. It doesn't help to come out with an answer and it becomes really obvious to the team that you don't know what you're talking about. So just be self-aware, and the more you can spend time before you come in and pitch for the first time, talking to others or socializing your idea with an investor, saying, this is not a pitch, I would like to get your feedback, I'm not ready to pitch, the more you can do to prepare, the better.
Yeah, I'm emphasizing what these guys are saying. If you can be direct and forthright about the challenges you're facing in your business, the things that are troubling you, because we're going to figure those out when we do our diligence anyway. So if you just come right out and say, I have a standard question, you get to the end of the pitch, and I say, well, what's keeping you awake at night? Because, yeah, you're going to make $1 million and everything's all great, and you're going to cure cancer and solve world hunger and everything, but what's keeping you awake at night is really what we need to focus on right now, because that's what's the challenge and that's the opportunity too. We're in the business of solving challenges and fixing problems, so we're used to hearing challenges, and if you're not forthright about it, first we're going to figure it out and we're going to have questions about your credibility. And then secondly, we're not going to be able to reach into our network and help solve that problem for you too. And we are here as more than just a source of money. we're here to help solve those problems, and so we just want to have an honest discussion about it.
So the key takeaway there is just be very honest. Don't go in there and overwhelm them with your sales skills. Just very forthright. But I do have to say, you got to show your excitement. If you are excited about what you're doing, don't hold back. Show the excitement, but do it very tactfully and with your key performance indicators. So KPIs. What's the key performance indicators that are important to each of you?
Sure, so I invest in 5 different verticals. So each of those are going to have a different set of KPIs or key performance indicators that our firm is going to look to really evaluate kind of what your stage is, where your progress has been so far. What we want to know is what are the KPIs that you are tracking? Because this helps us understand how you think about your business and what those metrics are that are guiding your managerial decisions that you're making every single day. So I think it's important to, yes, speak to the questions that the firm asks you, but also respond back with, these are the metrics that we care about, and here's why.
I'm going to pick up on that too. I think I agree. When you, at least at the early stage, each company is very different. Each industry is very different, and because you're startups, most of you are not. You're not the cookie cutter of something else. I can go to Wall Street and see that. I mean, you're coming to us because you're unique. So your KPIs are your KPIs, and we're interested in that. Sure, depending upon what the nature of it is. I mean, if it's a product, we're going to ask about gross margin, but it's probably going to be really low today. But is it going to get bigger? That we're going to ask about those kinds of things, and we're going to look at sales churn and ratio, and all the things related to employees, to revenue, and all that kind of stuff that we'll look at. But we're really interested in where are you today? What is your go-to-market plan? And then together, we can look with you at those metrics you either have or should have against your plan to go to market. And then we can decide how best to measure that and where we are. I mean, a little bit picking up on the last point that we were, I think, all saying, when you come to us and you're looking for investment, you're not just giving us an opportunity. What you're really doing is you're asking us to give you, not give you money, to invest money to help you de-risk, right? Those challenges that everybody brought up, that's what we're giving you the money for, is to help you solve those challenges along with our expertise and our relationships and everything else. So the metrics come out of that combination of understanding as we work with you at your very early stage. Hope that was clear.
I don't think I have too much to add. You as founders, entrepreneurs, or management team members, figure out the metrics that are most representative of your business. But I would say that what's helpful, that as you're trying to get different investors to invest in your group over time, is to kind of provide an update on how those KPIs or metrics are tracking. And I think that really helps to build momentum around raising capital. Is over a 3-month period, you've shown every month consistent growth in whatever metric it is that you're tracking, and providing updates on that. Those type of updates, I think, get people excited.
Yeah, I'm trying to think of what to add. When you're the 4th person in a panel, you get all the good stuff. So it gets harder when you get to this side.
You can just say ditto.
Ditto. I think the one thing to add, and I mentioned it in the last panel that earlier, was when you're raising capital, you're trying to get from one stage to another. So when you think about the KPIs, it's really, here's where we are today, and the capital that I'm raising is going to get me to this. And that's going to be very specific to the company, your company, and what you're trying to achieve. So it's not going to get you to an IPO and kind of this perfect state in the future. You're raising capital to get you to a very discrete set of accomplishments over a period of a year or two, whatever it might be. So the more you can be explicit about that and what that money will get you, the better.
Yeah. To add a little bit to that, really being very clear on with the amount of money you're raising. So let me just back up by saying many of the companies in which we will invest are in the regulated space. FDA is ultimately going to regulate them, and in fact, most of those companies are going to get acquired long before they actually ever make a product, or certainly before they sell it. And so it's really more about being clear on what milestones you're going to achieve with the money that's been invested, and how will that help you raise your next round of capital? Because you're going to have to raise sequential rounds of capital over a long period of time, and you need to be clear that whatever you're spending your money on is going to drive enough value and is going to be of interest to the next round of investors.
Yeah, I agree with everything. I think one thing that is important to me that we haven't talked as much about, this is very objective. We look at the business, we look at the fundamentals. There's a subjective side too, because entrepreneurship isn't easy. And every business has that point where you look at and say, how are we going to get through the day here? And you got to get through to the end of the day too. Or you got to make payroll, or there's some tough decision that's got to get made. And a lot of times you can't look at the page or the paper and say this person's going to have the fortitude to make that decision. But you have to look at management closely. And we spend a lot of time looking at the management team, what their backgrounds are, what their history is, and then getting to know them on a personal level before we make an investment too. And you can't really quantify that in a lot of the ways that we have, but it's one of the most important parts of evaluating your investment opportunity too.
So that leads to my next question, which is, what do you like to, when a company pitches to you, what do you like to see them spend the most time on? Is it the management team? Is it the financials? Is it the exit? What's the thing that you like to hear the most about? Because you have an hour. We'll start with you, Michael, and then come back this way.
This is easy for me. I want to hear how they're going to exit. I want to hear that they've thought through the milestones. They know what their fundraising plan is to get there, that they've got a clear vision towards exiting, and they're going to be able to get me there and make me 20 times the money I invested when I invested. That's what I'm looking for.
Eric?
Yeah, to that's important, but then I guess I'll just add that really we'd like to understand that the team that's responsible for driving this opportunity really has what it takes to do it. They really understand things comprehensively, and that we can really put our money behind them and be pretty confident that they can execute.
Yeah, those are great points. I think the knowledge of the space that whatever the company's in, the more they can talk about that. In particular, the more they can talk about the customer and the customers they have, and knowing the needs of the customer. It's easy to it's easier to build a product. It's harder to sell it and get in front of a customer and solve a problem. So the more you know what your customer needs are and demands and how you fill that need. I mean, they can't talk enough about that in pitches that we see.
Yeah, we tend to focus most on the technology. Is it compelling, differentiated, is where we spend a lot of our time.
Ryan?
I think we certainly want to look at the technology, the idea behind it, and does it make sense, and is there some form of validity? But I go back to the other piece. I mean, we will ask, what do you think your exit will look like? We don't expect you to know what it's $243 million, on this date. But broadly, where is it? Who's going to buy you? What do you need to look like at that point? And then as we sort of back that all the way down to where you are today, and you explain to us your go-to-market plan, what's the market, and what's your go-to-market plan, and how are you doing that, and how's that going to exercise along that path from where you are today, that vision of an exit, and it's a fuzzy vision, we all grant you that. As we look at that, as you articulate that answer, it gives us a chance to see who you are. Do you understand your industry? Are you calm? Do you know how to be strategic in your thinking? Do you know how to bring the right resources to the table to make these things happen? Do you have the resources today, or will you need additional ones tomorrow? All that will come out in that description. And that's a big part of what we're looking at, because we're looking at you. And the rest of it's important, but your ability to really capture that and not just, again, make it up as you go, but have it, that's a big part of what we look for.
Elise?
Another piece that I think is crucial is really understanding the market that you play in. So a lot of pitches will have kind of a competitive landscape slide, and they'll talk about how their product is, at the top of the list, checks all the boxes, or if you have the kind of quadrant, they're always in the top right. But really, it's important to make sure that you are conveying that you have a strong knowledge of your industry. If you tell us, oh, hey, I really only have 2 competitors, just like if there's a problem in your company, if there's another competitor out there, don't be afraid. Acknowledge that initially and kind of talk to us about how you plan to differentiate yourself from those different competitors. So when it comes time for an exit, you've really thought through what that process looks like and who you might be competing for to get that strategic to buy you out.
Thank you. So this one's going to require a short answer from each of you. So in 2003, there was a book written called Burn Your Business Plan. And the whole point of the book was write a deck and in a certain number of slides, paint your vision and present it. Because the people you're presenting to, they're looking at hundreds of deals every year and they don't have a lot of time. So business plans are irrelevant. So one, what I want to know is, how many slides do you like to see in a typical deck you look at? Like, what's the maximum that, if it's over that, you kind of cringe, right? So kind of the ideal. And then two, our business plans are relevant. So if you can, short answers, both of them.
All right, best case, 10 slides for the deck. At most, 15. I don't want to see more than that. If you have an appendix, that's fine, but I'm probably not going to look at it. And in terms of a business plan, I do think it's important for you to write the business plan because it's important for you to go through that kind of academic exercise of thinking through all those different key aspects of your business so that when we ask you a question about it, you've thought about it, you have a reasoned and answer that you can explain. But in terms of what you convey to us, you want it to be the most simple, clear, brief version of that business plan that you can.
Right?
I mean, I think that's exactly the answer. The slides, 15 to 20 is, 10 would be nice, but it's 15 to 20 is what it's going to be, not 30. And again, the business plan, I mean, I think the idea is exactly what Elise said. Is if you were, what I said just a minute ago about what I'm looking for in terms of your go-to-market plan, for you to be able to articulate that in those 15 to 20 pages, you must have some plan underneath that. So you have to have some reasonable business plan.
Right?
All right, I'll make it as short as I can. So our process, to start our process, you send us a presentation. So when you send us that presentation, that can be 100 slides, but probably the first 20 or 30 are the ones that are going to get looked at the most. During our pitch, it's an hour. I don't know what the right number of slides is there, but it's the duration is an hour. However much you can cover in that, accomplishing all the objectives that you need to have. And then regarding the business plan, we wouldn't submit a business plan to start off, but if we're entering in due diligence, a lot of that business plan material is going to be stuff that we ask for anyways when we submit kind of our information requests on things that we want to know about. So I think it's still applicable, but we're never going to ask for a document that says business plan.
I would just say ditto in this case. All good stuff.
Eric?
I'd say keep it relatively short, 15 slides or so. The key thing is if this is your first meeting, if things go well, then the process is going to be iterative and you're going to have lots of chances to talk to the investors subsequently. So you don't need to spill your guts completely on the first meeting. And you can answer questions if someone goes into detail, but you don't need everything on slides up front.
Michael?
2 key slides for me. Who's your management team and what's your problem and solution? And then we're going to go to work and figure out the rest of the details anyway. And I've seen these guys' due diligence. I know how much detail they're going to know about your business when they get done. So.
Thank you very much. So, Elise, you touched a little bit about this, and I want to go into a little bit more detail. So, addressable market size. So, you're in a medical device industry. So, how big is that market opportunity? How much knowledge do you like to see the startups present? And then competition. So, are you looking for a really thorough, robust, competitive analysis, or just like the top players in that marketplace? I'll start with you.
Sure. So typically we're going to look at what is the overall market that you're addressing. So if you are a minimally invasive surgical device looking at lower limb ischemia, as an example, we don't want to see, okay, what is the market for medical devices in general? We want to see specifically that market that you're addressing and how big that is, and then how much of that market you can reasonably capture. In terms of competitors, you don't have to list every single competitor out there. If you're in a very fragmented space, you could kind of segment the market yourself. What we want to see is that you really understand all of the key competitors that could kill your business. And so kind of coming out with a forthright approach and telling us all those different segments, or if it's just a couple big players, making sure you include all the big players is what we want to see. Again, this is a very simple, it's one slide in your deck of 10. So you want to kind of keep it to where we can move through it very quickly and understand your key points.
Brian?
I mean, I think we're very similar. I would just simply say we're looking for you to demonstrate that you understand your market and that there's a logic behind that market and the rest of what you've designed and where you're going. I'll give you an example of one. We had a very interesting presentation on some technology that was in the medical space, unique, tight kind of space, and the founder in making the presentation was arguing that, you know, in about a 4-year period of time, they were going to be able to exit for, you know, some really great multiples, because that's what happens in this business, which calculated out to about $150 million exit, is what he was thinking about. He got to his addressable market and concluded that his addressable market was $200 million. So we're going, so for a $200 million market, somebody's going to pay $150 million? You know, the conversation ended, it was over, and it was never going to be restarted after that. So, you know, you got to understand your market and how it fits into your business. Very critical.
What about competitors?
Oh, yeah, competitors, again, you know, due diligence is going to research out, you know, more of the competitors, but we're looking to see that you understand them and that, as Elise said, you've you know, kind of pulled them apart vis-a-vis you and your differentiators. That's what we're looking for.
Ryan?
We have the luxury of being focused on a particular market or industry, agriculture. So, you know, our group tends to know the market sizes and competitors well. And in fact, it's a bit off-putting for us, you know, if we see the pitches over and over, you know, talking to us about how big the market is for corn in the U.S. or that type of thing. So we know that's why we tend to focus kind of more on the execution or the technology, or probably the, you know, the kind of the biggest drivers in an area that we like to spend the most time during a pitch on.
Yeah, I would say the more you know your market and you can talk about it, it's kind of like my comment with customers earlier, you know, the more credibility you have, the easier it makes our job of really trying to figure out where do you fit into what market and where do you think you fit in, and then what's the, you know, a total addressable market versus kind of the serviceable market in the short term. You know, we don't expect you to have perfect information, but we certainly expect you to have opinions and a thorough understanding of the competitors and what the bigger opportunity is. So spend a lot of time on that, because it only it's a missed opportunity if you don't, and it's a big credibility builder if you, the more you know that market.
Eric?
So I'll just echo what most of these folks have said already, and to that I'll just add, don't make the worst mistake is an off-putting comment, similar to what Elise said, is to basically dismiss the competitors. That's not a good thing, to walk into a room and basically tell us that there's really no competition, because that's never the case. And so we don't want to hear that from folks. It doesn't help.
Michael?
I can say that one of the most frequent reasons that we pass on deals is because of the failure of the entrepreneur to understand their addressable market and have a realistic view of it, because it has a direct correlation to valuation too. And so if you don't understand your addressable market and what your real customer opportunity is, you're going to have an unrealistic view of valuation, and you're not going to be able to get a deal done with people who go in and beat that issue up. We spend a lot of time, I know you guys do too, particularly in the pharmaceutical space. Addressable market is a key metric for us on valuation, and we're going to go to town on that issue. And if it's not realistic, if you don't understand it, we'll pass on the deal.
Okay, so the previous panel had talked about the type of, or typical type of returns they would like to get. So I just want you to briefly kind of, for those who were not in this room on that panel and were in the other panel, if you could just quickly say what type of typical returns do you like to see on your investments? I'll start with Michael.
Yeah.
It's a little bit depressing how formulaic this gets at this point, but we're looking for somewhere between a 10 and 20 times return on every investment that we make. We have to get that because in our portfolios, 1 out of every 10 of our companies is going to succeed most likely. And so if we don't get those types of multiples, we're losing money for ourselves and our investors here. What does that 10 to 20 times mean? It means that you need to look at the life cycle of the company. where you are at the stage that you're investing in, how many other rounds of capital are likely going to be needed to be raised to hit the milestones to get the exits that's going to generate that return for you. And it's going to vary depending on the industry that you're in and the life cycle of the companies that you're looking at and the exit valuations inside of those markets. But the core formula is pretty much the same for us depending on, regardless of where we go.
Yeah, so maybe we look at it a little bit differently, but with the end game the same for our venture-backed portfolio, that our companies are going to have to raise money for from venture capital investors, and in many of these spaces they're going to have to raise tens of millions of dollars, and so they have to fit the profile of those venture capitalists. So for us, by the time they're out raising that kind of money, they have to be a really high-quality company capable of a 10x return, for example, to the venture investors and private equity investors that back them at that point. But for us, we have, as I said, different goals. So if we're going to put money behind a company that's going to create a lot of jobs in a small amount of time, we may be the only ones who ever invest because it may not be a really attractive deal to venture capitalists. And in that case, we're much more interested in how many jobs we can create, and getting our money back is sufficient if we can create a lot of jobs for the region. So for us, it varies quite a bit, depending on stage, whether you're going to raise venture funds or whether or not you have a different business model.
Brian?
Yeah, I think that those metrics and those returns are right. You know, if we think of our portfolio, we think about there's a time factor to it too, which if you were in the prior panel we talked about. So our fund is 10 years. So we need to see that 10, 20x plus in that time frame, and hopefully on the earlier side than the later side of that. So that's a factor into our thinking. We also think of the portfolio as kind of a third won't make it, a third will kind of break even, and then that final third have to have those returns to really give us the returns we need in a fund, you know, again, within that time frame. So, you know, venture has very kind of distinct kind of criteria that we need to adhere to, and we look at every investment through that lens.
Yeah, I don't have anything else to add, and we invest alongside these guys, so we have to have the same metrics that they have.
Brian?
I mean, we are a little bit more iSelect, like Mike was describing. We are, because we are investing at, at the pre-seed, seed stage kind of level, we are looking at, again, the 10 to 20. The time frame is, the time frame didn't used to be an issue for us. But we learned it needs to be, because we need fresh capital as well as the calculation of a return to be able to continue to put in your businesses from the last ones that came out. So, if we can get comfortable that that's going to turn over in that 4 or 5 year time frame, and we have some that we think will, 10x is going to work. The longer we think it's going to go, that number goes higher. And it's by definition. So there's your time frame and your IRR calculation if you want to start doing that. But that's the way we tend to look at that. And we have modified our portfolio where, a few years ago, most of them were going to be 10 or 12 years to exit. And we were just learning that, by the way, by accident. Now we're concentrating on still having some of those, but also looking for deals that are going to turn a little bit faster. So we broaden it a bit in that answer.
Elise?
Yeah, I think one thing that kind of comes into play, we're talking about, we're thinking about the fund as a whole, we're thinking about the holding period. So for many of us, we're hoping to hold that company, no more than 5 years before we reach a liquidation event or, an exit. One thing to kind of keep in mind is, what is the market adoption that you anticipate for your product? So even if you think there is a $1 billion exit opportunity, is that exit opportunity going to happen in the next 5 years? Or is it maybe going to take a little bit longer to kind of change consumer behavior to adopt your product? And that's one thing that, even if it's an amazing idea, if we think that we're just a little too early for the market, we may not come in even if there is a big exit opportunity.
All right, thank you. So how many of you were around in 2004 as an organization? Just raise the hands.
In 2004? No, we started in 2005.
Eric, right. And
Biogenerator.
you joined in
Not me
2007,
personally,
right?
Yeah,
Biogenerator.
Yeah.
So what's interesting about the St. Louis ecosystem is you're seeing it right here. In the last 15 years, it has changed significantly. And you have more people making more investments in more companies than ever before. And that's what's exciting. That's really what makes St. Louis an interesting place to start a company. So I'm curious, having made investments, what your view of the St. Louis eco startup system is. And we'll start with Elise.
Sure, I think it's been really exciting for me. So I just joined Cultivation Capital about a year ago, and really the last 5 years, St. Louis has seen just an explosive growth in terms of the amount of capital that is available for startups. So just about 5 years ago or so, startups in St. Louis raised $40 million. I helped write an article this year kind of looking at, we downloaded data from Crunchbase to understand, okay, how much did St. Louis startups raise in 2016? And the number was 290 million. So over the course of 5 years, we've seen, just incredible growth. Let's give it a round of applause for that. Because, while we appreciate, and at Cultivation, one of our values is entrepreneurs first. We understand that you guys are the people that are doing the hard work, you're working the 100-hour weeks, you're totally devoting yourselves to your business. Ultimately, you can't figure out if your business idea works unless you have capital to pay your bills, to pay your rent, to be able to scale your team. So I think Cultivation is a pretty great example. We were founded 5 years ago. And now we have over $100 million, over $120 million actually, in assets under management. We have 43 portfolio companies now, and that's across a number of different funds and accelerator programs. So it's a very exciting time to be in St. Louis. And as always, the cost of living here is cheap. So if you can raise money here, you can hire on a team that's a lot cheaper than if you were in Silicon Valley. And beyond that, there are a lot of other great assets that St. Louis brings, but I'll leave it at that.
Brian?
I have watched, and even just over the last couple of years, this continues to increase and improve, all for the benefit of founders, and it brings more founders to the table in terms of where we are, and that is the cooperation among these groups. It is fantastic how well we continue to improve the way we work together, and we just do it naturally because we each are bringing something so unique and different to the table. We understand our roles in the ecosystem. And I think we work really well together. I mean, it's turned into a fantastic deal. I mean, we worked with Cultivation a lot. We helped fund the beginnings of Cultivation as Arch Angels, and we're investors in Cultivation. Your success is our success, and I think that's really great. We're investors in some of the other funds. BioGenerator has been a dear partner of ours and very generous. With sharing due diligence and ideas, bouncing ideas, being open to discuss things with us in terms of where we are. And I Select the same way. We have some of our members are investors there. We talk, we share, we have ideas. And I think all of that together is what's helped this infrastructure grow. For Cortex to continue to grow and be what it is, T-Rex to grow and be what it is because of that cooperation. And there's others that we're not even sitting up here that are a key part of it, including Missouri Venture Forum, by the way. So, and I just think that's that's incredible, and that's what I see change so much. So,
Thank you.
$20 you owe me. No.
No, I thought it was 100 million.
I'm realistic.
Go ahead.
Yeah,
Ryan?
I mean, so today versus 2004 or even 2010, there's a lot more of kind of the underpinnings of the entrepreneurial ecosystem. There's a lot of service providers that understand, startup companies understand venture, the law firms, the accounting firms, consultants. There's serial entrepreneurs now. There's employees that have developed software in startup companies and know what that looks like. There's incubator space. There's a bunch of companies. So there's the opportunities here, the ecosystem exists. What we really need is the massive success story. We need a Varsity Tutors, Locker Dome, Teoma Pharmaceuticals to be massively successful. Because once we have that, that's like the match from all this kindling that we've been gathering. So that's what we need, and I think what a lot of us have been waiting for. And once that happens, once we have one of these kind of unicorns, we'll have something really to tell the world about.
Yeah, I would say the collaborative nature in St. Louis, and you could just, we all know each other, and we all probably in a number of companies together. That's something that sets St. Louis apart. I think St. Louis punches above its weight in that regard. We're focused on the Midwest, so we go between Boulder and say Atlanta, Toronto down to Austin. So we get to see all those ecosystems, and St. Louis absolutely punches above its weight. And how many companies, the variety of companies, and then again, I think the collaborative nature across those in the ecosystem is a great environment to start a company.
Eric?
Yeah, I've witnessed tremendous evolution in the St. Louis ecosystem, period of tremendous growth. When I stepped in at Biogenerator, there was Biogenerator and there was the Archangels, and that was pretty much it. And then you had to get from there to venture capital with no other stop along the way. And we've changed dramatically, and much for the better. Again, I'll reiterate that we have partnerships with everyone here on the stage. Those have worked very well, and those are essential because we don't have the amount of capital that other cities, other regions, big biotech hubs have to throw at startup companies. So we have to work together, otherwise we won't be successful. But what I would say is this region needs to continue to improve over time. We haven't yet had those exits. We need to continually get better. One of the challenges we have is because of the explosion of interest in entrepreneurial activities, we're starting more and more companies, putting small amounts of money into more and more companies, and every one of those companies needs follow-on funding, and that's a real challenge for us. We've had a lot of success raising money over the last couple of years, but the more companies we start, the more obligations we have out into the future. And each of us as organizations and as startup companies have to constantly challenge ourselves to get better, because only that way are we going to be able to successfully compete for the capital out there, which every one of the big companies here that has to raise tens of millions of dollars has to go outside St. Louis to get capital. And so you really have to be at the top of your game in order to be competitive for that kind of capital. So we all have to get better.
I have a saying that I tell my team, the team members in the audience are going to cringe when they hear me say it, but every success is the opportunity to fail at a higher level. And so, yes, we have a lot of success that we can build on here, but it doesn't mean the work has ended for us. We have a lot of work left to do in this community still. We need to get people down to see Cortex and T-Rex and the labs down here. I mean, I meet people at cocktail parties all the time who tell me there's nothing going on in St. Louis, and I say, why don't you come look at my block where there's $1 billion of investment happening because of entrepreneurship here? And people need to be made aware of that in our community. And there's not enough outreach. We need more. We've got a lot of money sitting on the sidelines inside our community right now that could go be deployed back into it. So we need to take the success we've had and promote it out further in the community and build and consolidate our gains and grow more, because we can.
It's funny you bring that up. So John from Fleischman-Hiller, our opening speaker, I don't know if you saw him, but he talked about a couple key things. One is, is it a St. Louis thing that we don't like to talk about our successes, right? I mean, he's from Ireland, and he notices it. He goes, it amazes me that you guys, you're a great city, and you do not promote yourself, and you really should, because St. Louis has done a really good job. And then his other point was perseverance, and so this leads to my next question. So I'm an entrepreneur. I've asked a lot of people, a lot of VCs, a lot of private equity people for money, and I've gotten a lot of no's, but I'm never afraid to go back to the same people and restate my story and give them an update and see if there's a yes. So typically when you have people pitch to you, if they come back, do you take offense at that, or do you go, just give us the update, we're curious? I mean, are you more curious about what they're doing when they come back? So what's your opinion on that?
Start down here?
Yeah, I can start with Michael.
Some of the best deals that we've gotten have been deals that we told the company, we tried never to just say no. We want to have a Socratic no that says, if this were to be true, we would make an investment in you. Because that's the way the community has to build itself anyway, is by being cooperative and helping each other. And then we've had companies take that advice and come back to us, and then we've invested in them, and they've been some of our best deals that we've done. So absolutely, that's the right way to have the conversation, and you should take all that advice and deploy it and try to make your company better. Eric?
Yeah, absolutely. We've been doing that for a long time, and we have cases where we've talked to founders for a period of a couple of years trying to give them advice, and eventually they make it over the hump, and then we come in. So we're always open, but what we're going to look for is if you come in again, we'd like to see some visible, really dramatic evidence that you've taken people's advice and you're different.
Ryan?
Yeah, that completely agree. And you have to keep in mind that we will look at 100 companies to find one. So I always think of the advice to the entrepreneur. You're going to have to talk to a lot of people and hear a lot of no's, and just don't let that bother you. Just keep at it. So that's how it works.
Ryan?
Yep. No, we're happy to maintain relationships with the companies over time.
Ryan?
Yeah, we do the same thing. I think that the onus is on you to ask, and we make a point. I mean, it's part of our program. We feel our role in the community is to invest, is to coach and invest. So we will coach you. If it's going to be a no, we'll coach you. Pre-screen, screen, member meeting, even due diligence, and it's very seldom it's a no, never. It's no, maybe, if you. That's kind of how we leave it. And so it's up to you to take that and ask for it, make sure you understand it, and then come back.
Elise?
Okay, so we've heard you can always come back, once you've demonstrated some progress, ask for money again, not be afraid to do that. With this in mind, don't burn bridges. Don't send the first thought maybe that comes to your mind when you get the unfortunate no of, oh, you're going to miss out on $1 billion company and you're going to regret this. Just keep things open and keep building those relationships. I think your relationship with an investor should be like your networking and having a contact, and that's something that you maintain and you can keep updating them. And I have some companies that will keep me updated every quarter or every 6 months, and it's a way for me to remember who they are. So one thing, as has been pointed out, we invest typically one company every 100 deals that we see. So it's going to have to stand out. And one of the ways that you can stand out is by building a relationship with the VC. I wouldn't underestimate that. And one of the ways that you do that is when it doesn't work the first time, keep coming back, keep updating, maintain that enthusiasm level, and eventually maybe we'll come to share that enthusiasm about your company.
So the takeaway there is it's not no. It's no, maybe, if, which is we might invest if you do these things. And so as an entrepreneur, you need to know to ask that question. So a couple questions you should always ask is, what would it take for you to invest? Don't be afraid to ask them that, because they'll probably tell you. If you hit this KPI, you do this, you hit this revenue milestone, we'll write a check, right? So perseverance is very important in entrepreneurship. It is business. They're going to give you their honest opinion. You may not meet their metrics or their KPIs right now, but in 6 months, if you hit a couple milestones, you can go back and they will probably give you a meeting for an update. So just take that under advisement. So we have about 10 minutes left, and then we have a reception. So cocktails are shortly around the corner, so I'll try not to keep you from there. So let me open it up to a few questions, and then we'll wrap up the event. So I'll start with this gentleman here.
Talk a lot about competition and making sure you know your competition. I was curious who you guys see as your competition, either in this region or elsewhere. What keeps you up?
Competition, what keeps you up at night?
I'm happy to start. I think right now the Midwest market is not saturated for venture capital investment. Although we have this great panel of people, we still have a funding gap in St. Louis. So when it comes time to raise a Series B, C, D, there aren't always the investors, there. So one of the things that we actually do, I have a metric that I have to hit, that 75% of the deals that we do have a strong syndicate of other investors around the table that can take that company from, whatever their current raise is to the next raise. So I think right now the collaboration is not just for the feel good, we actually rely on each other to be able to take those companies forward. And so the bigger threat, I guess, that I see is fatigued investors, because now we're about 5 to 10 years into this, well, maybe longer for some of
a little bit
the
more
folks,
than that, yeah.
15, 20. And some of the first people that came in have been investing, and they've been amazing assets to the community, but they're still waiting on that exit. They're feeling a little fatigued, and so what we're trying to do is find more accredited investors who would be interested in investing in startups, making some returns on their investment, but also investing in St. Louis as a community and thinking about it, from an economic development standpoint. So that's kind of where I see the bigger risk.
That is my answer as well. It is fresh capital to put in your businesses. That's what keeps me up at night. We need more accredited investors. We need more and faster exits so that money's coming back, it's recycled. That's what we need. That's what keeps me up, and that drives our strategy all across.
Eric?
Yeah, I would say for us it's less about competition because we're trying to work with a lot of groups here, but just making ourselves and therefore in the process our portfolio companies better and better over time. Because at the end of the day, if they have to raise venture capital, they've got to go all the way there and raise enough money to get to the end point and let the data and the business determine whether or not they'll have that great exit. But we need to make them good enough that they can raise the capital to have that opportunity. So if we don't get better, at the end of the day, we can sort of put all the money we want into companies and tell everyone that we're doing well. But if those companies don't continue to progress and raise money and get a shot at it, then really it's meaningless.
Michael, Ryan, Brian?
I mean, I'd say that there's not really any competition. I mean, I don't think anybody up here is going to go to work tomorrow and think, I don't have any deals to look at today. We've all got plenty of deals. The issue we need is more capital to invest in them.
Other questions? Back there?
Yeah, earlier today, Cliff told this audience that 73% of all venture-backed deals fail. I was wondering what you would tell a pre-funded organization, possible pitfalls to avoid, or what you all think are common causes of this.
Running out of cash.
That's right.
So the Kauffman Foundation did a really extensive study of this and looked at about 3,000 companies that had raised capital. And so we went out and acquired the raw data from Kauffman so that we could run statistical analysis on it. And we went out and did thousands and thousands of combinations of different companies in those portfolios, grabbing them randomly. And what we found was that once you hit a threshold of about 20 companies in the portfolio, that your returns tend to level out. And it doesn't matter which 20 companies that you grab, but there's a certain just statistical truth to the fact that once you get a certain breadth, you're going to have a ratio of failures and successes that tends to level out over time, too.
Yeah, I think maybe an answer to that is knowing those are the statistics of failure and for venture-backed companies, what you as a founder are, how do you think about that and what are you going to do differently and how does that impact your capital raising strategy or, other elements of your company? But, if that's a fact, how are you different and how are you going to manage that? Why will you be different?
I think a lot of those died of self-inflicted wounds. So, I think that's a big thing to really think about. It's lack of cash, lack of planning for cash, lack of the right resources, lack of understanding your market, lack of understanding go-to-market strategies, lack of understanding of external change impacting your business and causing new risks. It's a lack of getting the right kind of adequate support and service providers to support you as you go forward. I mean, the list goes on, but those are probably the big ones. I think St. Louisans, I think there's a very large, and I don't know if the number that was thrown around some time ago about the tens of thousands of, 55,000 accredited investors in St. Louis. I don't know if that's an accurate number. I think that might have been beer talk, but it's the number everybody uses, so I go with it. But at the end of the day, it's probably not far off. You think about our history, right? All these great companies that grew up, all these great exits that took place at those Fortune 500 company level, all the money that was left behind when that happened that filtered into estates and family trusts and everything else. There's a lot of accredited investors out there, and there's a huge number that are really interested in this area. But I think part of what happens is people, particularly successful business people, get older. They think they're supposed to know about this stuff, and they don't. And they're embarrassed, so they just kind of don't go there. And it's up to us, all of us, including you, to keep talking it up and saying there are vehicles to learn about this, and it's more than your money. It's about your civic pride. It's about what you've learned in your 20, 30, 40 years in business. It's about what you can contribute to make this a great community and help it to grow. You put all that together, we get accredited investors in investing.
Well, I would also add that we've heard that 73% of the businesses fail. We've heard how much diligence everybody on this panel has to do on a deal before we go into it. It's too hard for your ordinary accredited investor to do that work. You can't do 100 hours of diligence on every deal to get yourself a portfolio of 20+ companies. You just can't do that as an individual investor. So the only way that they have access is through some of our groups that are up here, and enough people just aren't aware of the fact that they do have access to venture capital in that way too.
Ed?
So you guys talked about the big exit, and my thought would be that if we had that big company, the company that made the big splash exit finally from St. Louis, do you think, A, is that close? Do you guys know some companies that are close to making that big splash exit? And second, do you think that's the kind of thing that will, because right now, if you guys, what I'm hearing is you said all the math on your return on investment to date with almost no exits or a few small, blah, blah, blah. It's hard to show a very good ROI for your, known current to these investors. When you get that big splash, the big return, maybe, does that pull people out of the woods? Does that give them the evidence that these things are going to go crazy? Does that make sense?
That is our hope, yes. That once we get that exit, people will get excited about it, reinvest that money back into the community. It takes time to build value, and so a lot of times the first exits that you get are actually companies failing, and it can be a little discouraging, and especially, if you're raising money for maybe a second fund, for example, that can be a difficult conversation that you have to have with investors. But yeah, that's our hope that in the next couple years, I'll say 3 years, we have a couple big exits for St. Louis.
I don't think a unicorn is critical. I mean, it's nice, but multiple multi-$100,000 exits where the people that are investing through these groups are getting real returns. That's, I think, more important than the one big one. One big one isn't going to hurt, and we'll certainly take it. We may not even be invested in it. We'll still be happy as a result of it, but
I think this is a matter of us not communicating well as a community, and not that we need to have an exit. Twitter was founded in St. Louis, okay? Square was founded in St. Louis, okay? Those are two IPOs that have happened in recent past that were big exits, I mean, we've got plenty of success stories. We just don't talk about them enough here. And
John was right.
Paul, go ahead.
Yeah, so Charter Communications was a second startup for that group, completely from scratch, sold for $4.5 billion. Mary Babcock is quoted as saying 50 millionaires were created the day we signed that paper. So we've had those, but we're embarrassed to share our success. And yet also we're bragging about how good we are, and yet we have some large grant companies who come here, and now they're leaving to other cities because they can't get other funding. So we've got two ends of the spectrum that aren't coming together. We've got to do a better job of communicating that and giving early startups a better hand up, not necessarily a hand out.
But that's the funding gap that they have been talking about. And I think most people who have been raising money in this town, we all understand that gap, right? So, Joe, go ahead.
Well, I kind of want to piggyback.
And I'll take one more after you, Joe.
All right, I'm going to try to turn this into a question. I was just going to say, I'm a native St. Louis, and the biggest problem with St. Louis is the St. Louisans. And what I mean by that is that everyone that grows up in St. Louis, nothing can happen here. Nothing can, you talk to people, and you guys touched upon that. Like, nothing can happen here, no good. I mean, like, it's amazing how you have to lead people over the head and say, there's interesting, exciting things happening here. And I think Mike mentioned that, like, walking up the story, and I don't know how we break past that, but I mean, I think.
It starts with you, Joe. Let me just address that, because I've been hearing that. I've lived in this market for 35 years. St. Louis is my adopted city. I've lived in other cities. I love St. Louis. I am an ambassador of St. Louis. Everywhere I go in the world, I was in London, I talk about how great St. Louis is. It starts with each of us, and we all need to just take it upon ourselves to talk about how great St. Louis is. And the more you know about St. Louis, and the more you talk about it, it is a phenomenal city. And I'll end with your question.
Yeah, the investors look at the companies who have generated the
So our team focuses a lot on technology, but technology alone is not sufficient to build a business. That there's other aspects around building the business that also need to be complete in order for it to be interesting or attractive to a venture investor.
It's all these things we've been talking about. I mean, that's great that you got that anchor, that foundation. Do you have the team? Do you understand the market? Do you have a good market strategy? Have you got something that's going to grow you to a point where somebody's going to exit you? You know, that sometimes that gets, the scientists sometimes are so focused on the science, they forget about the other sides of it. And that's might be part of the point.
Okay, and with that, we're going to wrap up the forum. Soren, do you want to come up and do the drawing? So we are going to give away a membership to the Missouri Venture Forum, a one-year membership valued at $300. It allows you